Hi, good morning, everyone. Going to let everyone join in. It'll be just a second. Thank you for joining us this morning. We'll give it till about 10:01. Right. Well, the numbers have stopped going up, so we will go ahead and get started. I would like to thank you for joining us for Alternatives for Financing Your Early Stage Venture. And we are listening to Lou Farina, who is a business analyst with Maricopa SBDC. And Lou, I will let you take it over.
Okay, thank you, Karen. Good morning, everybody. This is Lou Farina from the SBDC, and welcome to our webinar this morning. What are our options? The first part, and talking about alternatives for financing your early stage venture. So let me just give you a quick introduction. This is going to be a fast-paced webinar regarding several topics. And what we're going to do is after each subtopic, we're going to stop for questions. If you've got any, let us know. We'll stop at the end also. Karen will monitor the chat and the questions, and she'll serve them up to me at the end of each section. But we're going to go fast. I'm going to speak kind of fast. We're going to cram a lot of information into this hour and a half that we've got. So, just, resetting again, if you're an early stage company and you've been out trying to raise money, you'll find that it's really hard. It's one of the most tricky things to overcome. But, the good thing is there's lots of different ways to do it. And so we're going to try to explore these different ways to raise funds. And this is called alternative for financing your business. And it's usually what, from the SBD perspective, it's usually the alternative to debt. But I'm going to talk about debt just a little bit in this presentation. And really, this is all of them take time and money. All these different ways to raise money take time and effort. I'm sorry. And trying to figure out where you should focus and where you should start is really important as you think about your venture. Today, the topics are going to be talking about funding yourself. Grants, which is a topic that comes up a lot, friends and family. We'll talk a little bit about debt. We'll talk about crowdfunding, which is interesting, and then incubators and accelerators and how they may play a part in funding your business. So let me go back, and this is me. This is Lou Farina. This is what I look like on camera and in person. I'm a business analyst here. I focus on technology commercialization. And what really that is monetizing technology in on the business side. And so with that, I spend a lot of time with my clients raising capital, different ways. So that's why I've got kind of a background in different areas. I do everything really except debt, and we've got some expertise there we could talk about later. But I've got a background in technology ventures, corporate ventures, investing and divesting businesses for corporate, Fortune 50 companies. I was an angel investor here in town, although I'm not active. I'm also have some expertise in SBIRs, and I'm a reviewer for the National Science Foundation. So that's me. So I mentioned that this is a two-part series. I'm going to talk about it again here. So there will be part 2 to this, and we're going to cover some other topics. Part 2, and Karen can put the link in the chat. You have to register for it. Is next Wednesday, same time. Excuse me. And here's a QR code if you want to take a picture of this. So feel free to join us. We're going to talk about some other topics, and we're going to talk about competitions, SBIRs, angel investing, strategic investors, venture capital. What does that mean? Venture debt and corporate venture. So join us next week. Let me give you an overview here of the SBDC. In general, we are part of the America's SBDC network. Maricopa SBDC is one of 10 centers in the state. There are centers located all throughout the state. So if you're joining us from another locale other than Maricopa County, we've got other resources in your area. It is a national program, so there are SBDC organizations and resources in every state, and they are available to help in many different ways. What do we do? What do we focus on? At the top of the chart here is lender readiness. So if you have you need an SBA loan, we can help you find bankers and as well as get ready, get your loan package together and assess technology commercialization. We can do financial review, resiliency, marketing, buying, selling businesses, some manufacturing. We got some experts in export, international trade. We've got a sister organization in government contracting called Apex Accelerator. And then disaster loan assistance is at the bottom. We did a lot of that. We don't do much of that anymore. So what do? We do counseling. That's one-on-one. So you get assigned an advisor. We do training. This is part of training. We do webinars. Check our calendar. There are other webinars coming up throughout the year that are free to you. We're all no fee. And there are other resources. We've got market research available. We've got financial planning tools. We've got business planning tools. So that would be all at no cost to you. Should you sign up through our website, you have to register, and then you'll be assigned a resource. So let's talk about the big picture before we start to drill in. And this is called the equity investment progression. It's really kind of a funding progression. And what we do typically, there's typically a series and a time sequencing of different instruments depending on where you are. And so the first typically is self. We'll talk about that. Usually most businesses start with self-funding. Then we'll, arbitrarily call pre-seed, friends and family, crowdfunding, accelerators, competitions, all what we're going to talk about today. And grants, I'm sorry, also SBIRs very early on. And then after that, usually, you get some traction, you make some progress, then you're in the position maybe to talk to an angel investors, founders fund, we'll define that, or a strategic investor. So maybe some taking on some investors. And then after that, you start to think about your exit strategy. You start talking to maybe corporate ventures, which is a corporate arm of investment from large companies. And then maybe at the same time or before, a little bit after, you talk about venture capital. Not most folks need to get there, but we'll talk about that at the next session, what that really means. And then really far down the line, and we won't even talk about this, but then typically you're talking about IPOs or private equity at some point, some way to get the venture capital guys and everybody else off the cap table and try to monetize this and make significant amount of money. So that's kind of the sequence. And there, and it's not hard and fast, but it's fairly typical. Let's see. So let's talk about the first subject here is self-funding. As I mentioned in that sequence, the first money, you are always the first money into your venture. Very difficult to have anybody come into a venture unless you've invested in it. So self-financing demonstrates your commitment. Of course, the use of personal funds should be very carefully planned. And a sustainable business shouldn't require ongoing self-funding. So if you self-fund it and you seed it yourself and you're able to either generate profits or able to acquire next level stages of financing, that should be the path you take. You shouldn't, a business shouldn't require you to continually put money into it. Of course, you want to get money out of it at some point. So, oops, sorry. So there is this concept called relative burden. So you're talking about self-funding, and when we let's say an investor looks at your business and asks you about how much money have you put into this, and when they ask money, they ask hard cash, not necessarily time or even in-kind type of maybe equipment investments. And so what they look at typically is the relative burden to where you are in your life. On one side, you might be giving up pizza and beer, you may be of modest means. On the other side, you might be giving up a European vacation, but might be very well off. So, it's all relative burden. So, the example I use, I had a client who I was building an app, and they put about $30,000 into this app. Now, that's not a ton of money by investment standards, depending on where you are. But these guys were working the 4 to 9 shift at Amazon in the warehouse in the morning, to one, sustain themselves, and one, be able to generate income for their investment for their business. That means a lot. Now, I took the same $30,000 and I have somebody who's very well off, and that may not mean as much. That's not as much skin in the game. That's maybe a very nice vacation that they're going to miss during the year. So, money in is important. But again, recognizing there is a limit and perspective on what it means to you. The other concept that, if you're going to self-fund, and this really goes for any investor, but more for yourself, is this concept. You'll hear a word called bootstrapping, and bootstrapping is a definition, but it's doing more with less. So figuring out, being creative, because limitations, our boundaries usually force us to be creative. And how creative can you be? You'll be, I see a lot of different businesses. You'd be surprised how far people can get with limited resources, just based on ingenuity and creativity. So very important to keep bootstrapping in mind. While, if you're going to use your own money, you want to be really careful. If you use somebody else's money, you want to be really careful. Where, self-funding sources. So where do we get our money from, if we're going to invest in a business? So, one, your biggest source of any ability to invest is going to come out of your paycheck, right? Do you have a job? Can you sustain yourself? Do you have you invested your pay, per se, your income, or you have some savings? Most folks have had some savings and they're willing to invest their savings, go into their savings account. Very popular these days is home equity, right? Real estate's really bumped up here in the last couple of years, maybe more than that. And if you've been fortunate enough to be in the equity market, if you've owned a home, you've got some equity in your home, and unlocking that is relatively easy. And folks, you're putting your home on the line for your business. So you've got to be fairly serious. And then, anybody who's, we get folks that come out of large businesses and have 401ks they're sitting on. You can use your 401k to invest in your business. So these are some sources that you can use yourself. So at the end of each section here, I'm going to try to do just a wrap and just talk about what do we like and what do we got to watch out for with regard to the different topics. So in self-funding, what do we like? We like the fact that, if we self-fund a business, if we seed it ourselves, we have total control. There's nobody else around. And that is, we're also non-dilutive. Non-dilutive is a term I'll use, but that means there's no ownership, right? So not only do I have control because I don't have any partners and I haven't given up any stake in the business. It forces ingenuity, forces creative thinking. It adds credibility, right? This relative burden. How much have you put in relative to your means? And it saves time. It's fast, right? You can do it. If you got the funds, accessing is fairly easy. On the other side, of course, personal financial risk and family assets, along with stress and anxiety, right? Is all kind of coupled together. You're putting your family assets, you're putting your financial situation on the line, and that causes a lot of angst. And then there's limited growth, right? You can only go so far with your self-funding, depending on who you are, of course, but most folks can't fund their business through growth stages on their own. So I will take a second here to see if there are any questions regarding self-funding.
There are no questions in the chat.
Okay.
If someone would like to throw one in there real quick.
If not, we can just move on.
Oh.
Okay.
What is an SIBR, which I think you mean SBIR?
SBIR, yeah. Small Business Innovation Research grant. It's a grant from the federal government for seeding innovative ventures. We'll talk more in detail about that the next session.
And then how do I approach friends and family for funding?
We'll get into that. Good segue. We're going to talk about that here in the next 10 minutes. Okay, so let's just talk about grants real quick. And we get a lot of folks, so we went through a very terrible event, the pandemic, and it caused, well, a lot of government agencies to do what they could to, help keep this economy afloat. And there was a lot of money available on the grant side just to rescue businesses. Before that, and then now after that, there's really not a lot of free government money to start a business. So it's not something that is readily available. There are grants that exist on the federal, state, and local levels. A lot of them are targeted towards nonprofits. So if you're for profit, you're kind of left out. It takes a lot of time and effort to find these grants, to apply to these grants. The SBA does not provide any grant funding for startup and expanding a business. SBA program is a loan guarantor program through commercial lenders. And just overall, if you're able to get a grant, small business grant, $4,000 or $2,000 or $5,000 or $500, I don't know. It's just really not adequate to fully fund your business. So if you can get these grants, you've got some free time, go for it. But you got to think when you're starting out your business, you got to think about it a little bit more broadly. So grants.gov is a federal grant site you can look at. There's typically a pre-award phase where they put the opportunities out, and then there's awards and decisions, and there's a post-award, there's implementation, reporting, and closeout, just the typical way a grant would run. So that is something to look at. But again, it shouldn't, as an advisor for small businesses, it shouldn't be the focus of your funding strategy. So let's just, we did a real quick segment on here on grants. What do we like? There's cash. It's non-dilutive again, right? I'm not giving up any ownership. It can provide some visibility, depending on the granting agency. Usually the grants are discretionary use, which means that you can typically use it for whatever you want to. You got to check the terms of the grant, but that's pretty common. And there's emergency funding grants, right, that we went through here in the last, during the pandemic, but that's less available today, or if at all. What are the things that we really don't like, right? It's a lot of time to invest in search. You got to be able to write a grant. You got to be able to write a proposal. So do you have grant writing expertise? They're very competitive. You might be competing with 1,000 or 2,000 people for a $500 grant. There's small increments. They're not bigger increments. If you do get a grant, even though it may be discretionary use of funds, there may be reporting requirements that you've got to adhere to. They could be cumbersome. And again, overall, grants for starting business, it's really not sustainable. So, any questions?
Yes. What is the message for lenders and other additional sources of funding when entrepreneur comes looking for grants?
Say it again.
it says, what is the message for lenders and other additional sources of funding when an entrepreneur comes looking for grants?
Well, you know, you don't go to a lender for grants, of course. You don't usually go to granting agencies for grants. So I don't know if there's any messaging. I mean, if you went to a lender, let's say, and said, "Hey, my business strategy is, my capital is going to be all grant based, and that's what I'm going to base it on. And by the way, I want a loan based on that strategy." I think you'd be really hard pressed, unless you've got the grants in hand. And even so, even with SBIR grants, were fairly large grants, 250,000, $1 million, bankers typically don't won't lend. I mean, they're cash flow. We're going to talk about debt here. They're cash flow lenders typically. So, anything else? All right, let's move on to friends and family. Um, so this is an interesting strategy, right? So it is actually, friends and family actually is a form of crowdfunding, although we're going to talk about crowdfunding separately in a different topic. But, um, in for friends and family, people, your friends and your family are willing to put their trust in you to deliver um, a business plan, but it could be concrete or could be vague. It's not necessarily based on um, business criteria, right? Their affection is for you mostly, and that's typically their motivation. You're coming in with some credibility and some folks who've been around business a little bit. Yeah, having a business plan and having good engagement material is important. Um, and so the idea here in the form of crowdfunding is you take small amounts of money from several family members or friends to raise an overall sum. So you don't usually go to friends and family for a single check. It's usually an aggregation of checks. We call that's termed for investment. So that's kind of how you do it, or what you do. The you'll probably hear a term friends and family, and then people will always add fools onto that, and that's important. The friends invest in you because they believe in you, not necessarily the venture. The family because they believe in you, not necessarily the venture. Well, the fools, they don't recognize the risk of the venture, right? So they're in it, maybe in it because not because they like you or love you or have an affinity for you, want to see you succeed, but because they do want to make some money, but they don't understand how risky things can be early on. So and there are folks out there that fall into this category. So when you hear the term friends and family, you also hear fools, and that's the context for fools. Um, this is just little ethical consideration. You got to take the motivations of your friends and family round uh, investors and as well as their financial position, right? It can be really dangerous to take half of your nana's money to kick off your company, even though she might want to give it to you. No matter how confident you feel with your ability to succeed, what happens if you don't? Are you going to harm your investor, right? Your friends and family. So this is just, yeah, you can do it, but just be careful. As I put my angel investor hat on. When there's a friends and family round prior to angel investment, we usually like that because people are very committed to their family, and if you're willing to take Nana's money, typically that's a sign that you're very committed to your business, because that's kind of what investors look for, is commitment. So what do we, whoops, let's just talk about some investment vehicle options for friends and family. And this actually carries over to other investment vehicles too, but we're going to introduce these terms now and just talk a little bit about them. So, what's not on here is a gift. Gift means, all right, just, I'm not investing in your business. I don't really have any relationship to your business, but just here's some money. Go do what you want with it. Okay. So that happens. But however, be a little more formal, a little bit more business-like about it. I may, we may have a loan vehicle. And so a loan is just, expectation of repayment and interest. Could be a low interest rate, could be a high interest rate, could be no interest. Um, but so what does that mean from an investor? Well, if you loan somebody, you're really not an investor. You're not you're not a partner. If you were an investor, you would get to participate in the upside of the increased valuation of this venture as it moves forward. With a loan, you're typically just getting paid interest, right? And no matter what happens to the business, provided it doesn't go out of business. So that's kind of the downside of a loan from a lender's perspective or a friend's perspective. They're just going to loan you money. There are a couple other options um, that are used in friends and family rounds. One is a convertible note, and one is a safe, and this allows participation for the investor to get the upside of increased valuation of the business as it moves forward. Now, a convertible note is actually a loan, so it's got a coupon payment and a loan portion of it, but it will convert to equity at an initial valuation event. So if you go get investors and they decide that you got $2 or $3 million is your value of your company, when will you invest? Then your convertible note converts to equity. So there's a debt security, but you can get some of the upside. The other way to do it is a safe, and a safe essentially is it's kind of a warrant. It's your cash investment that converts to equity at the initial valuation event. So a lot like a convertible note, but there's no loan provision. There's no saying I'm going to pay this money back. It's when it converts. Safes are simple agreements for equity. That's what it's called. They're easy to understand and use, although depending you talk to attorneys, they may not be as easy as you think, but that's how they're built. There's no debt instrument, right? So there's no protection for the investor. Now, investors don't really need a lot of protection depending on who they are. But if the company fails, you get nothing. If there's no valuation event, if it never converts into a valuation at some point, the safe is a worthless warrant. Okay. So and here in red, we go to the next thing is evaluation. So if we've got an equity transaction, a true equity transaction, an investor will buy shares at an agreed to value or price. So we valued the company. We talk about how many shares. It's your company's worth $1 million. I'm going to put $100,000 in. You're going to get 10% of this company. But this really doesn't happen this early. Although, you see it on Shark Tank, and it does happen when you talk to more sophisticated investors later on, but it's really not something that friends and family rounds have to worry about. And really one of the things that is, the value, if you set your valuation too early, because a lot of times you don't really know if it's early in your business, you can't really set a valuation. We're talking about not just pre-revenue, like pre everything, right? Not just pre-revenue. So valuation, you really don't want to set it too early, honestly, because you could wind up giving away a lot of your company. Karen, you're on here, but let me just go through. So the good and the bad. Friends and family is pretty quick. It's convenient. It's accessible. There's really not a lot of transaction costs. You may have to get some of these documents drawn up. If you're really a risk taker, you can pull them off the web and do it, but I wouldn't recommend that. Again, adds credibility and commitment as you go forward. Right. Nana is going to invest in your company. You're going to pay Nana back. You're going to make this thing work. So what is the downside? So now you're entangling your business and your personal relationships. That could get kind of messy. I don't have to go expound on that, but it's overall higher risk for the entire family unit. Your investors may not be very savvy, and that's probably your friends and family might not be very savvy, but you may get a built-in panel of critics, right? Your friends and family may want to participate and help you and give you advice, and just because they put some money in, that could be really burdensome. So, Karen?
Oh, Sorry. Someone had a question. Can you clarify a bit more on the difference between loan versus investor? But I believe that you answered that for them. But
Okay.
I have a question. Who who orders the valuation? Is that something that the business owner does, or is that from outside?
No, yeah, it's outside. So there's no, so it's not a, it's not a valuation of a company based on existing operations, which you would typically go to for CPA or somebody if you're selling a business. This is a valuation event where an investor will invest in your company and you guys agree to what the value of your business is at that point to give them an equity position. And there is no, this is a very nebulous territory, let's just say. We'll talk about that when we go to talk about angel investors in the next session.
Okay, and then there's another question. I spoke with a stockbroker who suggested investing in the stock market. Could that be a viable way to fund the company? Thoughts?
Absolutely. Absolutely. If you know what, if you're a good investor and you are prudent, I won't give you my investment philosophy, but if you're disciplined to take enough of your income and put it into the stock market for a certain period of time, it's not going to happen in a year. But if you can do it over 2, 3, 4, 5, 6, 7 years, that that could be your stock portfolio. And I didn't have that up there, right? I had savings, but savings is kind of like stock portfolio. It could be a very effective means to uh, fund your business. I'm, little, I diverge a little bit, but I had a lot of young entrepreneurs, and it was not this year, but the last couple of years, who made a lot of money in crypto. I wouldn't, they bet a lot and they made a lot, and so they were able to invest in ventures, which is really risky stuff. I'm not saying invest in crypto, but same principle. Okay, I think I'll move on. Okay, let's talk about debt. Now, this is like what kind of our mainstay business at the SBDC, but I always like to joke, I'm around a lot of bankers and folks with lending backgrounds, and lenders are really risk averse. And that's coming, relative from an equity person, right? So, and my little picture here is that they wear the belt and the suspenders, right? They are looking to minimize their risk at all costs. Um, it's really challenging to get a bank loan for a company that doesn't have a financial track record today, especially in today's environment. Um, there are, the SBA loans for startup businesses, and if you read between the lines, a startup business in SBA talk is like, oh yeah, they've been around a couple of years. That's a startup, right? We're not talking pre-revenue typically. But there are some great vehicles for expanding your business if you've got expanding operations. SBA 7A loan, which is short and long-term working capital. You can refinance some business debt. You can purchase some furniture, fixtures, supplies. Good working capital loan. There's 504 for existing buildings and land, new facilities, machinery, usually collateral based. So there are some great programs, but they're typically not for the early stage companies. So let's talk about uh, lending decision factors. So if you're a banker, what are you looking at when someone comes to you for a loan, right? Do they have experience in this business? Okay. Do they have a cash down payment? Most loans are going to require some kind of cash down, especially an SBA loan. And remember, SBA loans come through commercial lenders, so just SBA loan guaranteed. How mature is the product? Is the product selling? Where is the product? What's the personal credit? Really important. What is your personal credit? You're going to want to personally guarantee any of these loans if they are made available to you, especially early on. Is there collateral? Can I attach? Do I have machinery? Do I have real estate? What can I attach to? Collateral is really important. Although they do prefer cash flow. Business plan quality. What's your business plan? Can you present? Do you have financial forecasts based on your track record? And then the one that it's really kind of invisible to folks is the industry sector appetite. Like bankers act like any other financial institution that take on risk. They'd like to diversify their risk, so they like to diversify their portfolio. So while you may be maybe you're an IT services firm that is doing really well, but they just happen to have a lot of IT services firms in their portfolio. They may not be interested in you, even though you might be a good lending risk, and there might be somebody else. So we typically can help you find folks that are that may look for your type of business. So here's just a numeric comparison. Okay, we got a little chart here, and this just talks about the risk return comparison, because it's all about risk return of an investor, let's say an angel investor versus a bank loan, right? So let me start with the bank loan. So let's say I want $100,000 bank loan. Today's interest rate, unfortunately, probably 10% or so, and maybe I want a 5-year loan. So at the end of that loan, I've paid it back. Let's just say I've paid it back. I've returned my $100,000 in principal to the bank, and I've paid interest or their profit of $27,482. How do I know that? I ran it through a loan calculator. And so the $27,000, that profit is really commensurate with the risk that they took, right? And it's relative, right? So let's talk about an angel investor. You come to an angel investor, you want $100,000. They say, I need about 10x investment. And we're going to talk more about angel investors in the next session, but I need 10x on my investment in 5 years. That's my benchmark. Why? Because it's super risky. You may not know it, they know it, because they invest in early stage companies. So what does an angel investor want? He wants his principal return of the $100,000, but he wants a profit of $1 million in 5 years. It seems excessive, but it's commensurate with the risk. The reason banks can loan money at 10% or 8% or 5%, hopefully not a lot higher than 10% going forward, is they minimize their risk. Angel investors, actually, they look for risk, but they look for high returns. So that's just a financial financial example of the two comparison. So let's just talk about startup debt real quick. What's good? Money to start your business or come close to starting your business. It can accelerate growth. Again, debt is non-dilutive, right? I don't have an owner. I don't give any ownership away. I maintain control. And also I could build up business credit. What on the other side, what might not I like about it? Well, I think I've made the point. It's really challenging to secure if you're an early stage business. It's going to constrain your cash flow, right? If you're paying your business, if you are able to get a loan, your cash flow is going to be diminished because you're going to have to pay that interest as well as the capital, as well as the principal back over time. So your overall cash flow is going to be constrained, even though you've able to get an injection at some point. You're going to take personal financial risk because they're going to ask you to personally guarantee it. And you may have to pledge some family assets as collateral, such as your house. So, Karen?
We have a question. What are some tips on building business credit? I have a checking account for my small business, but I have not explored any other options of building my business credit. Also, if I have good personal credit score, how does that reflect on my business credit score, if at all?
You want to handle that one? Because I'm probably not the best person on that one. Go, can you?
Okay. Yes, I can. So just a little background on me. I was a banker for 11 years, both consumer and commercial. And so one of the things, and I'm sorry, my very elderly cat is on my lap. So one of the best ways to build business credit is really the same way that you build your own credit. You acquire debt. So if you have not gotten a business credit card yet, then I would highly suggest that. You can start out with a low amount and build upon that. If you have not yet taken out a loan in your business, if you're, like Lou said, if you are a couple years old and you have a good track record, you're making money, you can go get a small loan even maybe if you don't need it, so that you can build your credit in a kind of controlled way. Sometimes a business line of credit is an excellent way to go because you won't pull that money out unless you need it. But it's always there for emergencies. So I always used to love suggesting to our businesses that they get a business line of credit. You can actually secure a business line of credit if you, depending on how your business is structured, by using your own assets. So, we were talking about home equity lines of credit. You can do a business line of credit that is secured by your house. And so, like I said, that way, if let's say you have $100,000 of equity, and that's, there are whole messy scenarios we can get into, but let's say you can access 100,000 of credit of equity in your house, and you get a line of credit. Then let's say you're a little short 1 month for payroll, then maybe you just need to take $10,000 out of that line of credit. That's all you have to pay back, is that $10,000. So once that's paid back, you have that full 100,000 to access at another time if you need to. So those are great ways to build business credit, but you don't want to overthink it. It's really the same way as building your personal credit.
Okay, thank you, Karen. Appreciate that.
Oh, we have one more question.
Go ahead.
What advice do you have for individuals who are consultants and were laid off? I have launched my consulting practice, but need help. What am I hearing here is there are no options for someone like me. If I can suggest, go ahead and make sure that you apply for counseling through our services, and we can assign a counselor to you that can work individually with you. And then I will let Lou take the rest of that.
Okay. Yeah, no, come see us. That's, it's not, as a consultant, it's not necessarily capital intensive. So we're not really talking about, capital injection, but come see a counselor. Hopefully we can help you. So, let's move on to the next, topic, is crowdfunding. And this is kind of an interesting topic. I like it. Because there's some new things that have happened. I say new in the last 3, 4, 5 years, that have been very, very interesting. But if you talk about crowdfunding, there's really two camps, and there was really only one camp up until a couple of years ago, and it was really donations rewards, like non-equity, right? So you get like Kickstarter, Indiegogo, GoFundMe, even. Those are all ways to crowdfund for a certain purpose. We'll talk more specifically about that. But the other way now is equity. You can actually crowdfund for equity under certain rules, Reg CF, Reg crowdfunding from the SEC. It's kind of a fairly new regulation that allows these platforms like Fundable and Crowdfunder and WeFunder to exist. So now you can take on investors with smaller increments. So the difference between investing and making a donation in exchange for promised reward, right? Kickstarter, Indiegogo, that's all promised reward donation. The other side, Fundable, Crowdfunder, WeFunder, that's actually investing. That's actually equity, or something that converts to equity, actually, in most cases. So let's talk about crowdfunding just in the context of marketing. So whatever platform you use, whatever side of the fence you're on, if you're in the donation side or even if you're on the equity side, one of the keys to crowdfunding is, provided you have a good concept, is marketing, right? Being able to create a good story and create that content through, developing a project page, a video, some outreach through social media, your blog, email. This is really, really critical. And the platforms really don't do this for you. They enable you to do this. So if you're good at content creation, storytelling, then you're going to have a good chance. If you don't, there are like experts that can help you, fee-based, for your marketing. But a lot of, it's it doesn't happen automatically. There is a big marketing element to crowdfunding that I don't think people realize going in how much time, resource, and effort it actually takes. Let's talk about Kickstarter. I think this is probably one of the more prominent platforms. What do they take? They take about 5% of what you raise, and you're only charged typically if you successfully fund you hit your funding goal. They approve all projects. There's an application process. You're obligated to provide rewards, and the rewards have to be of your own creation. You can't just be giving away other stuff. And again, as I said, there's fee-based experts that can help you with your campaign strategy, your storytelling, and whatnot. But if you're good at that, and lots of folks are today in the age of social media, they can do pretty well with Kickstarter. There and Kickstarter and some of these donation reward platforms are really good for creative projects. That's typically where they excel: art, film, music, board games, fashion, social impact projects, really big, gaming. So those are kind of the type of ventures you'll see on a platform like Kickstarter. But now let's switch over to talk about crowdfunding equity, and I'm going to use WeFunder as an example. So as I said, this regulation from the SEC provides an easy way for non-accredited investors to invest in early stage startups. So just some context and background: prior to Reg CF, which I think maybe is 8 years old now, 7, 6, you had to be an accredited investor to invest in non-regulated startups. And essentially what the government was doing was kind of protecting you from yourself, right? We don't want folks we didn't want folks that did not understand the risk and are savvy to invest in startups because they maybe didn't understand it and there was not a good symmetry of information, let's just say. So, but they finally changed, and Reg CF allows this, and it's really good. It's been a good source of capital for a lot of startups. WeFunder, for example, will charge up to 2% of the investment. They'll also charge the company raising money up to 6% of their total funding volume. So, they take a cut, the platform. There's usually in WeFunder and some of these others, there's a lead investor. So a lead investor will do some vetting, look at the startups, and maybe start to negotiate a single set of terms, and then bring other people on as the platform, or as you stimulate the platform to get other investors. And what's important, and this is kind of a subtlety, but what happens is if you've got 10 or 15 investors through WeFunder, they aggregate that investment, and they create what they call an SPC, a single purpose LLC, to form an investment, and it'll be all of the members will be the investors. So, but there'll be one entry on the cap table. So that's important as you go down the line. You don't want to, if you start to talk to semi-professional investors, you don't want a lot of people on your cap table for various reasons. So WeFunder, who do they kind of serve? What do you see? Startups, early stage companies, consumer products, a lot of technology and innovation. They do some social impact. There are some creative projects on there. Real estate is done on there. Local Main Street businesses, which are not usually, really candidates for early stage like angel investing. You may be able to pick up some investors here: hospitality and food, consumer brands, etc. So interesting. Here is an example of a successful crowdfunder campaign, and this is one of my old clients, Carlocity, Peter D. He ran it, and he gave me permission to show this. But he raised 160,000 plus on WeFunder. But he really used it initially as a friends and family aggregation. So, we talked about friends and family. Well, how do how do you do a deal with 10 different friends and family? I mean, how do you get the same terms? So this is one way to aggregate them onto a platform. Like WeFunder will make you got to have to bring in the first $50,000 to the platform before that platform will start to um, push your venture to other investors on the platform. So that's kind of a little bit of a gate for them. They want to see if you can raise 50 on their platform, bringing your own people in, your own friends and family and investors, and then they'll start to push it. In his situation, they raised 2/3 of their money from friends and family, and about another third from outside investors on the platform. And that's fairly typical what I hear. So well, we're able to get friends and outside investors, primarily valuable for aggregating friends and family investments. The thing about this though is Peter, who's a really bright guy, he he wrote and curated his own marketing copy material. He was a really good storyteller. Um, and so, the story as it was laid out was really engaging and very interesting. And that was that was really part of his success, I believe, in addition to having a successful, at least concept at the time. So let's switch over. Okay. Why do we like crowdfunding? Okay. As all of these accessibility to funds, you got reduced financial risk, right? You're not taking on a lot of financial risk. It can build momentum. Um, so you can actually, start and you start getting visibility from investors, and all of a sudden, there's the word kind of spreads, opens access to new networks as part of that momentum. And it also can be a way to test the marketability validation of a particular venture product, let's say. So good, like a good smoke test. Why, why don't might not we like this? Time and money, right? Takes a lot of time, and it's going to take a little bit of an investment on your part really to get started. You're going to pay fees, so you're going to pay a percentage, to the platform. Um, you could have a failed campaign, right? I mean, what happens if you have a failed campaign? You don't hit your mark, right? That's a problem. You've wasted a lot of time and money. And this is something that's really real. I mean, it's idea theft. You're putting it out there. You may not have intellectual property protection at the time. So you got to be really careful. People stealing either your ideas or your concept. And you also, while we talked about testing marketability validation, there's the other side of that is a false negative. If you do poor marketing, then you don't really run that platform correctly, or optimally, then it may fail, but it may not be the concept. It may be just the way you engage the platform in your marketing, which happens actually a lot. So you got to be careful here. Bring it, take it too much away from it. So Karen, is Karen still there? Karen, any questions?
Karen is still here. No, someone had a statement that they've also used Patreon
Okay.
as a source for crowdfunding.
Okay. There's lots of them. If you want to put that in the can they put that in the chat?
It's already in the chat.
Yeah. There's lots of crowdfunding platforms. Just vet them. There are some that are fairly mature, so that are really reputable. So good. So am I on to my last one? Incubators and accelerators. I think so. I think we're getting the last situation. Okay. So these terms are used a lot. You'll hear them. They mean different things. There's subtlety, but there's differences. And we're going to talk about how they can help provide capital injection, at least the accelerator can. So what's the difference between incubator and accelerator? Well, an incubator is, an environment of collaboration, support. You're refining ideas, you're building the company from the ground up. Okay, so you're incubating the idea, and usually there's a facility and maybe a program to help you incubate your idea, get started, and be able to do some of the early stage things that need to be done with your business. An accelerator is designed for select startups with promising MVPs, minimal viable products. That's your early stage product. And and founders, very promising products and founders as a way to scale growth rapidly. Okay, so you've incubated it, you've got some momentum. You go to an accelerator provides mentorship, capital, connections to investors and business partners. And we're going to talk a little bit about capital as a part of the accelerator experience. So here's just a Venn diagram with regard to some of the functions of accelerators versus incubators. So, incubator could be open-ended in duration. Typically you pay for it, or you maybe there's no payment, but a lot of times you can pay for it. There's facilities, there's physical space, there's rolling emissions. You get mentoring, typically you get support, and it can be selective. It oftentimes is selective on the incubator. But an accelerator, again, typically growth based. There's payment via equity rather than fees. So there's no fees, but you're going to give up equity. It's usually fixed duration, and it's cohort based. So you're in with a cohort of 8 or 10 different companies, and it's a accelerator. So it's weeks or months of very intensive work. But there is seed funding as part of your equity agreement with the accelerator. So that's really the crux of it here. The accelerator provides capital in exchange for equity. So they're taking a piece of your business. They're taking on some risk. They're going to give you some cash. They're going to put you in a cohort. They're going to give you programmatic delivery of education with some curriculum, and they're going to take 7 to 10% ownership of the company. So when you see accelerator, typically that should, if you're at the stage where you are a candidate for accelerators, then usually what you're going to do is give up some part of your company to the accelerator. And the accelerator makes their money off of, if they do their job right, that your valuation has increased after the acceleration program, and therefore their stake has increased after the accelerator program, and that's where they make their money on the exit after investment post accelerator. So let's see. So what do we like about accelerators? We like the cash. We think the mentoring can be really strong and very valuable. The cohorts, if you're in with a lot of other high performing companies and founders, can be very fertile ground for learning. The duration is typically, I'll say short, because you won't be in an accelerator for a year or two. You'll be in for months, weeks or months. And the program intensity, it's typically a very intense program. But on the other side, it's not for everybody. The program intensity, you're going to dedicate a lot of your time, and will be beholden to the accelerator staff and program for that period of time. There's dilution. You're giving up. Dilution means you're giving up stake. You may have some limited autonomy at that point. Right now, you got an investor in there. They act as an investor, and they may steer you in certain directions that you may not want to go. Quality control just means there are good accelerators and there are not so good accelerators. Do your homework, reach out to people. And the really important thing is, because this is an equity-based transaction, you got to read the fine print, read the terms of that agreement. There's warrants, there's right of first refusal. There's some limitations, things that they can do to you. There's the NDA. So I would definitely take a look at the fine print, or have somebody who knows investment terms review your contract. So, Karen, I think I'm at the end, and I think we did good on time.
We did. I have a question. Where does one go to find incubators and accelerators?
I don't know. They're everywhere and they're nowhere, right? We have an incubator here at the college, CEI. Right? They're typically a bio incubator, but they're doing some other incubation type of work. if you're in the investment in the startup community, you'll run into people. You can do you do searches on incubators and accelerators. There's famous accelerators, that are very well known, that you can apply to. So yeah.
Okay, and then someone put in the chat to everyone that ASU Entrepreneurship and Innovation. And there's also Carol Farabee AZ Business Incubator. So, okay, great.
Yeah, there's lots of them. Just ask around. And, come, we can help you with that too. If you're looking for an incubator, Seed Spot is another incubator. ASU does a bunch of incubation type of programs all over the map, different ones, accelerators are a little bit harder to find, right? Because now accelerators have to have, some cash typically to invest. What's it called? The new one that's here in town, Plug and Play. Plug and Play is an accelerator, right? They're a cash-based, equity-based program.
Okay, and we have someone who raised your hand, but I don't have the ability to let you talk. So if you could put your question in the chat. Oh, someone asked, how do we get paired with a counselor? So let me tell you, do you have that on a slide, Lou?
I think I just flashed this slide here.
Oh, perfect.
Go ahead,
Yeah.
Karen.
So in order to request counseling, go to our website, which is maricopa-sbdc.com. Across the top of that page, there is a request counseling link. Click on that link, fill out that form to the best of your ability. We have options. We have little check boxes that you can check the specific things that you want. We also have a note section. So if you need something specialized that you don't see listed, feel free to put that in there. If you need in person rather than Zoom, put that in there as well so that we can get you to the right person. I think that may be it.
That's it. Okay. So yeah, come see us. We've got counselors available. Thank you all. I'm going to just flash to this one slide, my slide on the next. Okay. Part 2 next week, 10 a.m. Same time, same channel. We're going to talk about some things a little meatier, a little more in depth on some of these things. And these are things that have usually the higher dollar values associated with them. So come see us next week, register, and we'll do it again.
Yep.
Thank you very much.
That link is also in the email that I sent out yesterday. It is a second link. So you can, if you have not yet signed up for that, feel free to go ahead and use that link or use this QR code. Okay. So perfect. Thank you, Lou.
Thank you very much. Take care.
Oh, I'm going to send this out so you'll have that information.
Okay.
Just so you know, someone asked if they could see the speaker's contact information again.
Okay.
So.
Sounds good.
All right, great. Thank you. Have a great day, everyone.
Okay.
Bye-bye.